One growth tactic that I feel is just underreported on or talked about is community rounds. Could you first tell our listeners what is a community round?
It's a way of raising money where you're opening up the fundraise to let your customers and community invest. So most startups, when they're raising capital, they're using an exemption called Regulation D. What this means is that they're limited to raising from institutional investors and accredited investors, so rich people basically. And what a community round does is enable you to raise capital also, maybe as well as raising from VCs and angels, but now you can also let your customers and community invest. So an angel round, you're raising from angels. A friends and family round, you're raising from friends and family. A community round, you're raising capital from your community. And there's kind of two benefits to this, right? One is it's another kind of way for startup founders to raise capital. This is a relatively tough time to raise capital. So a lot of founders are kind of interested in exploring other avenues, other pools of capital that they can kind of draw from, e.g. your customers. But the other thing, and I think probably the focus of this conversation, is our pitch is if you're a consumer-facing company, or it can work for B2B as well, but B2C tends to be the sweet spot. If you're a consumer-facing company, you're trying to build community, most startup founders are looking for ways to delight their customers. Most startup founders are looking for ways to build stronger community. And our pitch is there is no better way to delight your customers and build community than by letting those customers and community members become owners and investors in your startup.
Hi, and welcome to the Optimize podcast. My name is Nate Matherson, and I'm your host. On this weekly podcast, we sit down with some of the smartest minds in growth and go-to-market. Our goal is to give you perspective and insights on what's moving the needle. Today, I'm thrilled to sit down with Jonny Price. Jonny is the VP of Fundraising at WeFunder, a platform that enables startup founders to raise capital from their customers and community. This week's episode is a little bit different. We're going to talk about what I think is an underreported on growth and go-to-market strategy. That'd be community rounds, a type of funding round that more startups are using as part of their go-to-market strategy. Thanks for listening to this week's episode of the Optimize podcast. It's brought to you by Positional. If you don't know by now, my name's Nate, and I'm one of the co-founders of Positional. And we've built what I think is a pretty awesome tool set for content marketing and SEO teams. We've got tools for keyword research, internal linking, content optimization, and even a couple tools for analytics. We'd love for you to check it out at positional.com. Jonny, thank you so much for coming on this week's episode of the Optimize podcast.
Thanks for having me, man. Great to be here.
Could you tell our listeners a little bit about you and the work that you do at WeFunder?
Yeah, absolutely. So if you believe my LinkedIn title, I'm the VP of Banter at WeFunder. Although another way to describe it would be VP of Fundraising. I've been at WeFunder for 6 years. Before that, I worked for a nonprofit called Kiva.org. Before that, I was in management consulting from the UK originally, lived in SF for 10 years. Now I'm in Nashville, Tennessee. But yeah, what we do at WeFunder, as you mentioned, we're a platform that helps startup founders raise capital. Normally, when you're raising capital, you're raising from VCs and angels, right? At WeFunder, we allow you to raise from unaccredited investors as well as accredited investors. So open up the raise to let your customers and community invest. So we call it a community round. So that's like on the startup founder side. And then on the other side of the marketplace, we're enabling anyone to invest in startups they love, not just rich people. So for 80 years in America, you had to be an accredited investor to invest in pre-IPO private companies. Our founders back in 2012 thought this isn't very fair, this isn't very American. They were actually serial entrepreneurs themselves. They wanted to invest in their friends' startups and they weren't legally able to. So along with other people, they helped to lobby to change the law. And since 2016, now unaccredited investors have been able to invest as well. And so one way you might kind of think about WeFunder is like democratizing angel investing. So just as like with Robinhood, democratizing public investing, or with like Airbnb, democratizing hotels, Twitter, democratizing journalism. So on WeFunder, we're trying to open up so anyone can be an angel investor, not just the richest 5% of the population who are accredited investors.
I've been excited for this conversation all week. On our podcast, we typically talk about content marketing and SEO, but lately we've done a few episodes in the growth and go-to-market space more broadly. One growth tactic that I feel is just underreported on or talked about is community rounds. Could you first tell our listeners what is a community round?
Yeah, so the idea is it's a way of raising money where you're opening up the fundraise to let your customers and community invest. So most startups, when they're raising capital, they're using an exemption called Regulation D. What this means is that they're limited to raising from institutional investors and accredited investors, so rich people basically. And what a community round does is enable you to raise capital also, maybe as well as raising from VCs and angels, but now you can also let your customers and community invest. So an angel round, you're raising from angels. A friends and family round, you're raising from friends and family. A community round, you're raising capital from your community. And there's kind of two benefits to this, right? One is it's another kind of way for startup founders to raise capital. This is a relatively tough time to raise capital. So a lot of founders are kind of interested in exploring other avenues, other pools of capital that they can kind of draw from, e.g. your customers. But the other thing, and I think probably the focus of this conversation, is our pitch is if you're a consumer-facing company, or it can work for B2B as well, but B2C tends to be the sweet spot. If you're a consumer-facing company, you're trying to build community, most startup founders are looking for ways to delight their customers. Most startup founders are looking for ways to build stronger community. And our pitch is there is no better way to delight your customers and build community than by letting those customers and community members become owners and investors in your startup, oftentimes on the same terms as VCs that are leading the round. So a great example recently was this company Beehive, newsletter platform. They raised a 32 million Series B led by NEA. They announced that on April 30th. And then on May 1st, they announced that they were opening up a community round allocation for an additional $1 million. And they were opening that up to let their customers and newsletter writers, readers invest. They oversubscribed that in 2 hours. And so now their newsletter writers are kind of stakeholders, owners, investors in Beehive on the same terms as this VC NEA who led the round.
Yeah, it feels like I'm seeing this more and more, especially on platforms like Twitter and X, where companies are mentioning that they're opening up an allocation for a community round, and I guess it serves like an initial bang to the customer acquisition strategy because everybody is talking now about this community round that's available. And you mentioned in 2 hours, the Beehive round was oversubscribed. But then it seems like there's also this prolonged effect where I see, Mercury, for example. I think you guys did a community round with Mercury. I feel like I see people on Twitter or X saying oh, I am an investor in Mercury. And it's some guy that you've never heard of before, but he's preaching great things about Mercury, maybe because Mercury is a great product, but also too because now he has some skin in the game. Would you say that it's accurate that a community round is not a round that the company necessarily needs to raise? They don't need this capital. It really is just a way to build support and community and help supplement everything else they're doing on the go-to-market side of things?
Yeah, I think it can be both, right? Those are usually the two use cases I give. I think the sexier, cooler use case for WeFunder is in the case of Beehive, they did not need the money. They just raised a 32 million Series B, right? For them, it wasn't about the capital. For them, it was we just want to give our customers and community the chance to invest. And there's many other Mercury that you get an example you gave a couple of years ago. They raised 120 million Series B. I think Code2 led it. Andreessen Horowitz invested. And then they opened up a $5 million allocation. $5 million is the most that you can raise through this regulation crowdfunding exemption every 12 months. So then Mercury opened up a $5 million allocation, I think it was 2,500 of their customers invested, again, oversubscribed in 24 hours. So for them, again, it wasn't about the money. They didn't need the money. It was just a customer engagement. But there's this other use case for WeFunder where actually, it would be helpful to raise additional capital and, have other investors that I can pull from. We have 350,000 people now who have made an investment in WeFunder, and we'll put startups in front of those people. So, a lot of the money in raises will come from WeFunder investors. A really good example here is this company, Leah Labs. So they're a YC company. They're trying to cure cancer in dogs. and they went through YC a few years ago. And they talk about this on their WeFunder case study. If you go to communityaround.com, you can find some cool case studies. Leah Labs is one of them. And so they went through YC. They were pretty early. They had a lot of science risk ahead of them. And so a lot of VCs were saying, we want to see more kind of progress first. They then ended up raising $500,000 on WeFunder from a community of dog lovers. And they weren't B2C, right? They're a biotech company. And then they went on to use that money. They've gone on to raise follow-on grant funding, VC funding. So they're an example where the use case was less around kind of customer engagement and more around like, oh, this is an interesting avenue to kind of make it a little bit easier to raise capital.
Yeah, I have a few really tactical questions. So in the case of like a Beehive where that round like got oversubscribed in 2 hours from the community, like what do you do if you're like the founder of that startup? Do you like squish everyone down in terms of check size to let more potential community members in, or like do you run the risk of just telling some folks like they missed out? Like,
yeah, I don't know if that's a risk, right? That's kind of I mean, I guess you could say it's piss and muff. I would say like it's better to like invite your customers and community to have a chance to invest in you, and some of them get to participate. I think in the case of Beehive, it was around 1,000 investors. I can double check that, but I would say it's better to invite them to like not invite them at all. But yeah, there's a few options, right? You can kind of pare everyone down to keep kind of under the allocation, or you can say, first come, first served, or you can do something like, the people that signed up on our platform like the earliest will get kind of precedence, or like, yeah, some other kind of criteria.
So we can do like some prioritization based on, are they an existing customer? What's their spend on our platform?
Yeah.
Things like that. And to kind of pick out who we want to give allocation to in a round like this.
Yeah.
Okay. And as far as like, maybe a stupid question, logistically, like it sounds like these are a lot of very small checks. Like I think you mentioned before, like a $500 check. These are all like one line item on the cap table for founders, right? Like they don't have to report to a $500 check holder.
Correct. Yeah, we use a special purpose vehicle and SPV to roll up the investors to one line on the cap table. And yeah, the average investment on WeFunder is $1,000. It looks like Beehive, they had 889 investors. They raised a little more than $1 million, so a little more than $1,000 for them. Across all companies on WeFunder, the average is $1,000, but the median is $250. The minimum, you can set a higher minimum if you want to, anywhere up to $1,000, but most companies will go for a $100 minimum. I think Beehive went for a $100 minimum. So for them, it was just about, we want more of our community to have the chance to participate, so we'll lower the minimum right down to $100. But yeah, from a cap table perspective, it's like pretty simple. It's just SPV, like a Reg D syndicate.
Yeah, and so once one of these like community rounds closes, we've got like the initial social bang from promoting this community round. Hopefully some of these investors are now going to talk more positively about our company and on social media and wherever else and to their friends. As like founders, should we do anything to, stay in touch with these folks, or like how should we like work with these now new investors on an ongoing basis? Is that even important, or is that something we just don't need to really worry about?
You don't need to worry about it. There's no kind of obligation. Obviously, generally, I think it's good practice to like keep investors abreast of what you're doing and update investors. And yeah, hopefully, as a founder, like if you're engaging that community, they obviously love the product, love the brand, love your company. So I would say you want to kind of nurture that. And so I would recommend like a quarterly, update that goes to those investors. Doesn't need to share kind of sensitive financial information or anything like that, but just like keep them engaged and hopefully excited about what you're building, and ask them for their help, right? They're like literally financially invested in you now. You can like put them to work for you. So you need help with hiring, or like you have a, kind of marketing like announcement that they can help amplify for you on social media, or they can help make an intro to like an enterprise customer. Like, yeah, just get creative and like asking them for help, and they should be willing to provide that help.
Yeah, I know like you've done some pretty high profile community rounds with like companies like Mercury, which we mentioned, also Substack. Does it ever make sense for like a Substack to do multiple community rounds? Or is that something you've seen, like, a community round for the Series B and then also maybe another community round for the Series C? Does that like work in practice, or have you seen any companies do that?
Yeah, definitely. Levels is a good example of another Andreessen Horowitz-backed company that they raised a community round with us a couple of years ago, and then they just did another one recently. And Kelmix is a CPG company, a hair care brand out of Chicago. Black female founder, Kim, she's awesome. She raised, I think it was like $3 million a couple of years ago, and then did another multi-million-dollar raise, I think earlier this year. Yeah, definitely. And I'm biased, obviously. I work for WeFunder. But for me, especially if you're, consumer facing, or especially if you're trying to build community, then do it every round, like pre-seed, seed, Series A, Series B, Series C. I don't think we've had any Series C companies yet, although we're talking to a few right now who would do this as part of a larger Series C round. 5 million, with 5 million is the annual cap, so it starts to be relatively small as a percentage if it gets like super large amounts of capital. But yeah, like, do 200K allocation as part of your pre-seed, 500K as part of your seed, $1 million as part of the Series A, etc.
I've seen like, RUVs out there, like roll up vehicles, which, still require accreditation. But like the big difference here with like a community round is that it doesn't require accreditation. And so anyone of any net worth or amount of dollars in their bank account can participate in one of these rounds. Is that why the cap is 5 million and it couldn't go above that due to that difference in accreditation?
Yeah, exactly. It's the SEC exemption that founders are raising capital through. We're talking here with community rounds and WeFunder about regulation crowdfunding, whereas most startups are raising through Regulation D. Regulation D limited to accredited investors, no upper limit on how much you can raise. Regulation crowdfunding allows unaccredited investors, but the SEC cap it at $5 million per year.
Yeah. Are there any other like downsides that like founders should maybe be aware of? Like I've heard, and you can tell me if I'm wrong, that you need to like release a lot of financial information like publicly as part of facilitating one of these rounds, from the company. I mean, is that like accurate? Like what sort of information do you have to provide in order to allow one of these community rounds to happen?
Yeah, I would say that's the biggest downside of Reg CF. So the SEC say, because retail investors here are investing, we need to protect them a little more. And the way that we're going to protect them is to kind of force companies to share financial information. And so you do need 2 years, or if it's a startup, then just going back to the incorporation date of the company. But if you've been around for longer than 2 years, and you need 2 years of financials, P&L, balance sheet, cash flow. And then if you're raising more than a certain threshold, more than 1.2 million, they need to be audited by CPA. So there's also a cost to getting that CPA audit done. And then that is kind of publicly shared with the SEC EDGAR database in the legal SEC filing, Form C filing. So I would say if you are really sensitive about, competitors seeing that financial information, then that's sometimes a deal breaker. It's a little bit in the rearview mirror. So if you were to launch a WeFunder community round today, which is July, August 2024, you only need to share 2022 and 2023. So it's a little bit in the rearview mirror. But yeah, if you're super sensitive about not sharing your P&L for the last couple of years publicly, that might be a reason not to do it.
I know I'm bouncing around a little bit, but can I, if I'm the company, offer like perks or like incentives to participate? For example, like, and I'm using a fictional example here, but say I was like Beehive and I was raising a new community round. Could I give like, a discount or, like a free month or an upgrade to like the community members or customers that invest into the round?
Yeah, totally. We see that a lot with like CPG companies, like spirits companies or breweries, where it's like, okay, get a discount at online checkout or something like that. But yeah, perks is fine, and usually different levels. So if you invest $1,000, you get a certain perk. If you invest 5K or 25K, you get kind of the next level of perks for sure. You don't need to do that, but it's quite common.
Yeah. Well, I imagine it's probably more common for like the earlier stage startups, maybe, or like the consumer facing startups where you actually want to give like the customer the product that they've invested in. I guess you can do that too with software, but it's maybe not as tangible as like a bottle of whiskey.
Yeah, I don't know if like, Substack or Beehive or Mercury or Replit. I don't think these guys were doing too many perks. And yeah, didn't stop them from raising $5 million in 24 hours.
Yeah, definitely doesn't seem like a requirement. As far as like mistakes we could make with a community round, are there like one or two like mistakes that I could make if I'm a founder launching a community round?
Yeah, I think one thing would be kind of setting an allocation that's too high and being kind of overreaching in terms of like how much you're looking at raising, because, especially if you're not doing this to raise some money, if you're just doing this to let your customers invest, then, if you set a goal of 5 million and then you kind of over 3 months, like slowly limp towards, 1.4 million, it's like not a great signal. So sometimes folks will kind of start with a lower like allocation, and then if they oversubscribe that, they can always kind of increase it from a position of strength. So I think like getting the allocation right, I think partly the reason Beehive was such a strong signal to oversubscribe the $1 million in 2 hours following on from Series B announcement, it was just like beautiful like optics, I think. And so from a signaling perspective, like don't overreach with the allocation that you're looking at opening it up. I think the other thing would be like, I always recommend like lean into the execution. So, how can you really make a big bang of this? Like tell everyone about it, like beautiful page, really awesome. You don't need a video edit, but like if you have great kind of creative assets, I think that can really help. If you go to the Replit page, wefunder.com/Replit, I think the video of their founder Amjad on there is just very compelling. So just kind of executing, it's going to take time and resources and investment, not so much on the monetary side necessarily, but more on the kind of time investment. For me, like your marketing team should really be leaning into this. I say this is, and not just me, but like Rich White is the founder of Fathom. I don't know if you know Fathom. It's like a kind of video, like AI note-taking tool. I'm a customer. I'm a very happy customer. He did a community round a couple of years ago, raised $2 million from VCs and $1 million on WeFunder from his customers. And he described this as the best marketing campaign he's ever run. And so if that's true, then like really lean into it, like get your marketing team to, kind of make the execution of the campaign as awesome as possible. And then not just with raising the money quickly, but to your point, like on an ongoing basis, hopefully you're going to reap a lot of marketing customer engagement benefits from that down the years.
And now just a quick word from one of our sponsors, actually our only sponsor, that is Positional.com. Positional has what I think is an awesome tool set for content marketers. We've got everything you need to take you from start to finish and help you scale this channel, as I've done over the last 11 years of my career. We'd love for you to check it out at Positional.com. So just to play it back, it sounds like we should pick a round size, at least initially, that we can fill fairly quickly. Then we can always increase it later if we need to. And in the case of Fathom, where this community round was, a third of their total round size, like maybe we need to be a little bit more polished and thoughtful about the marketing to the community round itself versus like a Beehive who just threw a link on Twitter, I would assume, and subscribed it in 2 hours.
Yeah, and it's a really good point, right? Like, depending on how much the allocation and how much investor demand there is, it kind of changes the need to be polished. Like Substack didn't have a video. I don't think Mercury had a video, right? And they oversubscribed $5 million in a day. So if they've been trying to raise 25 million, then maybe they would have needed to like invest a lot more on the kind of the marketing and the polish side. So
yeah, companies like Mercury and Beehive and Replit, like if they ever need $5 million, I feel like they could just like throw up a link, given that people already love their product so much.
Superhuman is I love Superhuman so much. Like it's literally my favorite product ever made. The iPhone maybe will push it, but right now, Superhuman, it just saves me so much time. And yeah, as Superhuman, they could just like spin up wefunder.com/superhuman, send an email, boom, $5 million from 5,000 like happy customers. And so Rahul, if you're listening, do it.
Well, so I want to ask, like, growth side of things for WeFunder. Like, do you have to go out and like ask these companies to come onto the platform, or is it mostly
sadly
inbound
yes
to you? Yes, you do.
Oh no, sadly, yeah. But yeah, we get a lot of inbounds, right? And more and more, I think our growth is coming from referrals, which is really cool. Whether that's like founders that have been really happy with the experience and are sending us referrals of other founders, or like increasingly from VCs. And I think especially in the last couple of years, right, it's been harder to raise like VC capital way down, like VC dollars deployed in 2023, 24, from where things were in 2020, 2021. And so, yeah, VCs, and especially VCs with kind of consumer-facing companies in the portfolio, like saying, oh, actually, this worked pretty well for our other portfolio companies. Like, hey, like, I think this could be an interesting fit for these guys. So we're seeing more referrals come in these days.
Yeah, for consumer-facing companies, is WeFunder almost like a replacement for Kickstarter? I feel like I don't know like if Kickstarter was started before WeFunder. I don't even know if Kickstarter's still in business because you don't hear about it anymore. But is a Kickstarter for a consumer-facing company very competitive in theory with like a WeFunder?
I don't really think so, actually. I think it can be both. Like if you are consumer-facing, yeah, Kickstarter can be good. Tends to be that companies will raise more money on WeFunder. It's just a different thing, right? Kickstarter is kind of crowdfunding of like perks or like a product discount. It's almost like revenue or perks, whereas WeFunder is like invest in the company. So I would actually say they're pretty complementary and they're just quite different things.
I have a really tactical question. I'm friends with like a handful of investors, and they'll kind of joke to me that like sometimes when you bring on like unsophisticated LPs, they'll like ask for their money back in like 3 years from now. And, it's a 10-year fund. Like there was no capital to be returned in 3 years. But they didn't really understand that, I guess, when they had invested. Do these investors understand that it's going to take a long time and like that there's not going to be liquidity, like, in the next two years, likely it's going to take a while?
I think so. I had always thought that would be a real like valid concern of like, am I just going to have to answer a ton of annoying questions from, all these kind of small investors? But I don't think I've had one founder who's done a community round and WeFunder kind of voiced that concern to me. Maybe it's happening and they're just not voicing it, but I think I would have kind of got wind of that. So yeah, I actually don't think we're kind of having that issue. Yeah. And like, the SPV, like the shares in the SPV are voted on by a lead investor that the founder designates. So from a kind of governance perspective, if there's a follow-on financing or position that requires the vote of shareholders as a founder, you just go to the SPV lead who votes on behalf of all the individual investors.
Gotcha. So we don't have to round up like 500 signatures.
Yeah, exactly.
Okay. Well, you mentioned you do a little bit of outbound, it sounds like, to bring some companies on for these community rounds. Is there a single company besides Superhuman, which you already mentioned, that like you would love to have on for like their next round and supplement it with a community round?
Liquid Death came to mind. Like people love that brand. Like I just think that their whole messaging is around like engaging the community, right? And so sustainability, like kind of mission-oriented companies, impact-oriented companies, I think do well on WeFunder as well. So yeah, Liquid Death, we want Superhuman, we want any kind of custom company that has a kind of passionate audience that is really passionate about building community. It's sometimes frustrating to me. I like hear founders talk about, oh, it's really important to us to build community, right? But then it's like, okay, cool. You should let your community invest. Wouldn't that be an awesome way to build community? So hopefully our vision is like in 10 years time, if you're building a community-oriented or consumer-focused company, like the standard, the default like MO will be, of course, why wouldn't we invite our customers and community to become stakeholders and owners with us alongside our VCs? That's the kind of future we're trying to build. I think it's going to be a few years for it to be like very, very common and like normalized that every B2C company will allocate 10% of every round to let their customers invest. But yeah, more and more case studies. We're crossing the chasm. That's the future we're trying to usher in as fast as possible.
Yeah, I'm sure you could fill that liquid death round in under 2 hours.
Yeah, oh man, I just dream of like the kind of, the marketing and the creative and the assets will just be so fun.
Yeah, maybe it's top of mind because we talked about Mercury, but also like Ramp. That feels like another one where, Ramp customers love Ramp.
Digital banking, like Monzo is a digital bank in the UK that actually did a community round, actually before we coined the term. WeFunder came up with this term, community round.
So you guys invented this term, community round?
Yeah, and talk about go-to-market, man. That's been such an interesting like insight for me into the power of like naming and like kind of branding. So before that, we would call it equity crowdfunding or investment crowdfunding, and a lot of people still call it that. But we always hated crowdfunding because, to your point earlier, everyone's like, oh, you mean Kickstarter? It's like, no, there's a different thing to Kickstarter. Also, crowdfunding, it doesn't really sound that prestigious.
It doesn't sound good. It actually sounds kind of bad, like equity crowdfunding.
And it's literally like for a VC or a founder, it's like, oh, you want to do crowdfunding? No. You want to do community round? Like your community invest? Sure. It's literally like just changing the name. And so we rolled out communityround.com in 2022. And we had some fun with the rollout of that. But yeah, so this has been kind of a really interesting example of like, naming and branding and kind of WeFunder's own go-to-market. And that was only like a couple of years ago that we kind of coined that concept.
From the founder standpoint, community round feels a lot more comfortable than equity crowdfunding because, you've got your investors who are like, if you do an equity crowdfunding, maybe that's not the right signal. Like, whereas a community round, it feels like I'm doing something like proactive to acquire customers and support my community. I realize that they're the exact same thing.
They're the exact same thing, yeah. But it's just such a powerful example of like changing the name, and it changes the signal and the kind of perception of it. But yeah, and it can be a negative signal, like I said earlier, right? Like if you set that allocation too high and you're out there spamming people and you kind of fall short of the goal, like that ain't great, right? But then it can also, I tweeted when Beehive did their raise, like just kind of went through exactly what they did. It's like, this is an emphatically positive signal. We oversubscribed this in 2 hours. We are inviting our community and customers to become owners of Beehive. Alongside this VC that's leading the round. They really did it from a position of strength. So my argument is this can actually be a positive signal, if you execute on it well.
Yeah, totally. I agree. Well, that's some incredible branding work. And I want to talk a little bit more about like the go-to-market strategy of like a WeFunder. Like, how do you think about like new investor acquisition or like what are those primary drivers to get new investors onto the platform?
Yeah, so it's pretty interesting. We're a two-sided marketplace, right? We have founders and investors, and on the investor acquisition side, pretty emphatically, the strategy is find awesome companies like Mercury, and they will bring the investors. So you have Uber, right? It's like we're signing up drivers and we're also signing up riders. For WeFunder, the drivers bring the passengers, the founders bring the investors. We've had 350,000 people make an investment on WeFunder over the last few years. And the vast majority of them were brought to the platform by, the company that's raising.
That's interesting. So for you guys, it sounds like bringing on those like high profile, like high intensity deals, like then just adds to your customer base who might then also be interested in all of the other, I'm assuming, tens or hundreds of deals available on the WeFunder platform. So like in theory, if you guys were to go and get like liquid death and like, I'm talking theoretical here, like charge them like no money to like do this community round, that's just going to like bring a whole new cohort of potential customers to then take a look at all of the other community rounds happening on a platform like WeFunder. Is that right?
Exactly right. Yeah. The only like caveat I would say, yeah, there's the high intensity ones like, Substack, I think signed up 8,000 new WeFunder investors the day they launched. But also, WeFunder's doing investments into local neighborhood coffee shops and restaurants So there's a company in Nashville where I live, a restaurant called Bad Idea. They raised 700 grand. I think it was like a couple of hundred investors. That's like 200 like people in the Nashville community who are now also on WeFunder. And we have like hundreds of those, kind of maybe more smaller or local businesses. They're also bringing a lot of the investors here. So it's not only the Mercuries and the levels of this world that are kind of driving the investor acquisition.
That's really interesting. And that's a good point. It's people love their local coffee shop, and they might also be interested in then investing in like a cure for their dog's cancer. So it makes complete sense to me. Are there any other growth marketing channels that you guys have been really excited about here in 2024?
I mentioned the founder referrals, the kind of referral partners of like VCs, angel groups, fractional CFOs, lawyers, folks that are working with startups that are kind of sending folks our way, accelerators. We get a lot of inbound. We've never really done much in the way of paid ads. We actually have some like Facebook, Instagram ads that are running right now focused on breweries as a channel. Like we wondered if that as a kind of industry vertical would like do a little bit better. I don't really see, the kind of Series B tech founder like signing up for WeFunder from a Facebook ad, but we're actually seeing some interesting early results on the brewery side. Like you might see, think of the economics, like if the average company in WeFunder raises 400 grand, typically we might make 8% of that. So that's like 32K of revenue. Like that's a pretty high LTV. So we have some room to play in. The kind of funnel conversion is quite low and the cycle times are quite long. So it's quite hard to kind of understand like the economics of digital ads, but we are running some Facebook, Instagram ads as a test right now. We've kind of experimented down the years, never really found anything conclusive. So it's never really been a big channel for us up until this point. We've kind of played around with some content marketing. We have a podcast, Adventure Capital, where we like highlight the stories of founders that have done WeFunder. One thing I think that's really useful for is like if there's a CPG founder that's looking at launching on WeFunder, then I'll share with them the interview where I interviewed like the founder of Kelmix for an hour. And that's like a really awesome way for them to understand like her experience and like how she executed on it. So I think that's more around kind of funnel conversion, I would say, than kind of top of funnel. We've had like, we do a lot of kind of cold outbound emails, like social DMs. And then, we have a BD team that I lead, which are like going to events. This is really cool. You will like this one. We just did a 2-week entire company train trip across the US. So if you go to wefunder.com/train, you'll see it. Did you hear about this?
Wait, you did what? You went across the country in a train? This is a fun. Why didn't you lead with this? This sounds like a fun go-to-market strategy.
Yeah. This is a very like WeFunder thing. So we literally just last week concluded this 2-week Amtrak trip where we left San Francisco and 2 weeks later rocked up in DC, and we're taking Amtrak trains along the way. And then every city we stop in. So we stopped in Portland, and then we stopped in Whitefish, Montana, and Grand Forks, North Dakota. And then on the east side of the country, it was a little bit more concentrated. But like we had an event for founders in Grand Forks, North Dakota. And just earlier this week, I chatted with one of the founders that was there. They've raised $18 million from VCs in North Dakota. I think they're one of 2 companies that raised a Series A last year, maybe. And now they're looking at doing a $5 million WeFunder raise. So that was a really fun, like kind of outbound like strategy. Not sure that would work for every company, but it was a fun one for us.
Well, heck yeah. So you guys got on a train, went to startups where they are, like in North Dakota. And I mean, 18 million bucks in North Dakota, that's maybe like all of North Dakota. You know what? For any listeners of this pod that are in North Dakota, you're welcome to come on the podcast.
North Dakota, we love you.
Yeah, we love you. We love you.
I think that was like the impetus for the Jobs Act, which was the law that like allowed us to do this WeFunder regulation crowdfunding thing. Legally allows unaccredited investors to invest in startups, not just rich people. The impetus for the law was like, right now, 77% of venture capital goes to 3 states, California, New York, and Massachusetts. So wouldn't it be cool if we could get more capital flowing to founders throughout the country? So the kind of WeFunder going to North Dakota is like very much in line with the spirit of the regulations that we're kind of using here.
Yeah, I spent like 6 months in Iowa, actually, and I loved my time in the Midwest. Very different venture ecosystem in a place like Iowa. You've got your small angel groups that want to invest, $100,000 at a $300,000 post.
I was literally just going to say for like 30% of the company. Yeah.
Yeah. But I love how you guys are democratizing, capital to all different places across the country. And as far as you mentioned regulation a few times, is that an important part of the business in the sense that like you try to change laws, or do you have lobbyists? Like, are you trying to open up the floodgates in terms of the amount of capital companies can raise or how they can do it? Is that an important part of your business?
Yeah, that's an interesting question. It's not. We don't have any lobbyists, so we don't spend that much time kind of lobbying regulators or anything like that. The start of WeFunder back in 2012, our founders basically started a petition to lobby Congress to change the law that helped to result in the 2012 Jobs Act, which then the SEC rolled out in 2016. So the start of the company was actually really entirely about kind of regulatory change. The SEC made some rule changes to Reg CF in 2021, where they increased the limit from $1 million to $5 million, and they allowed us to use SPVs from a cap table perspective. So, but that wasn't really, our CEO did actually write a letter to the SEC saying, hey, we think you should make the adjustments in this direction. But it's not like we're flying to DC or paying lobbyists to make these changes. Maybe we should. Sometimes I think we should be investing in that, but I don't know. These things take so much time. We're like a small startup. I think we're maybe 30 or 40 people. So it's doesn't really seem like a good time investment of our limited resources to kind of try to lobby for regulatory reform, which may never come.
Yeah. Well, there's at least 5 senators that listen to this podcast, so they've heard a little bit about WeFunder today. Now, I'm totally messing with you.
You're totally messing with me. It's actually more like 35.
Yes, all of Congress. It's mandatory listening. And this has been so much fun. I've got some lightning round questions. Does that sound good?
Hit me.
So, we were talking about Nashville before we started recording, and you and I joked about Hattie B's, love it or hate it. Is there a restaurant in Nashville that our listeners should check out if they're in town?
Oh, this is a beautiful setup because I'm just going to highlight Bad Idea, which is a new restaurant, Laotian food. The founder used to be the sommelier at this other restaurant called Bastion. The wine selection is incredible. Unbelievable food. Crowdfunded on WeFunder. Sorry, community rounded on WeFunder. Thank you, yes, Nate. But yeah, my wife's an investor. We love the spot, and it's really, really good food. It's in East Nashville, cool part of East Nashville called 5 Points.
Well, we will include a link to the menu in the show notes of this episode, so all of the listeners definitely check it out next time.
And the WeFunder community round page.
Oh, are they still fundraising?
No. They concluded their raise.
Oh, good for them. Yeah. Good for them. Next time, if they raise the second community round for location number 2. I'd seen on Twitter recently, there's this company called Carry. I think they're in the IRA investment space. I don't know exactly what they do, but they announced a community round as part of their Series A. And I went through the questionnaire. I didn't complete it, but one of the questions they asked was, do you have a large social media following? Because, allocation will be given to folks that have large social media followings. Is that a good approach? Should we allocate to folks in our community round that might have a lot of followers on Twitter?
Yeah, I mean, I think it depends on what the allocation is. I saw that Carry raise as well. I like that they use that term community rounds. I think they were using AngelList, and I think it was limited to Reg D and accredited investors. So that's the big difference versus what we do at WeFunder and Reg CF. So if you just want to limit it to a smaller number of people, maybe investing larger amounts, all of whom are accredited, then you definitely should not do WeFunder. You should get an AngelList. What WeFunder and Reg CF is about is opening it up so that anyone can invest. They don't need to be accredited, i.e. a millionaire. And yeah, to the point earlier with the Beehive example, if you're oversubscribed, then yeah, you can you could do it based on social media followers of the investors if you want. I don't know anyone on WeFunder that's done it in that way. I think that could be a little I don't know. I can imagine some people being a little miffed about that if they don't have enough social media followers to make the cut. Also, logistically, that just becomes a little challenging to figure out and manage.
Yeah. Well, I should probably also mention that one of the other prioritization factors was, are you a current carry customer? So they are doing both. Are you a customer or do you have a large social media following? So don't I'm carry. Looks like a cool product. Don't know that much about it. As far as your two-sided market goes, you've got to acquire customers, investors, and then you've also got to acquire customers who are companies. Is it harder to acquire one versus the other?
I don't know. I would say no. I would say it's there's a relatively decent balance. I don't know. Don't have a better answer than that. It's kind of hard to acquire both, right? But on the investor side, it's kind of mostly the founders, like I mentioned earlier, that are kind of bringing the investors. So the focus of our company is more on the founder side of the equation.
Looking back, what was the most memorable or most fun place that you stopped on that train ride across the country?
Well, I actually was only on it for a couple of legs. So I have a wife and 3 kids who were on vacation at the time. So I was on family vacation from Tennessee and California. And then I was oh, by the way, can I leave our family vacation to go across the country on a train trip with my colleagues? Not so much. So I flew to Portland and then did Portland to Whitefish. Both were cool. Portland, we had a really fun pickleball event with founders there. Had some great conversations with founders in the Portland community. And then did an overnight train to Whitefish, slept for 0 hours on the overnight train, which was not so fun. But then I'd never been to Montana before. Absolutely beautiful town, Glacier National Park right there. And had a really awesome conversation with a VC who's a partner at Quiet Capital, who'd invested in Substack and Mercury at this happy hour that we organized for folks locally in Whitefish. So it was really cool to find, very awesome person in the startup space to meet with, even in a town that is pretty small and you wouldn't necessarily have thought you would kind of find someone like that. So both those places were really fun. But yeah, sadly I didn't get to participate in too much of the train trip.
Yeah, well, you've made it as a VC if you're San Francisco VC now in Montana.
Right. Yeah, that's ultimate status, right? You're so much of a baller, you can go to Montana.
Yeah, I invest out of Montana now.
Yeah, exactly. Hey, you want to come visit me? You got to fly to Whitefish. Sorry. Yeah.
Same check size, though. I'm sure there's some great Montana VCs, though, too. But anyways, Jonny, this has been a lot of fun. Thanks for coming on the Optimize podcast. Is there anything else you'd like to say to our listeners?
I would say obviously, if you're a founder listening, you're interested in exploring this further, would love to connect. I'm Jonny at WeFunder.com, and then WeFunder.com/raise is where you can go to kind of learn more and start an application. And then also, if you're someone listening, you love startups, you want to invest in startups, you can do that on WeFunder. $100 is the minimum. You can browse through hundreds of companies that are raising right now. Some YC companies on there, some cool venture-backed companies. Maybe it's a restaurant in your neighborhood. The idea for us is democratizing angel investing, getting more and more, hopefully over time, millions of Americans investing in early stage private startups as well as late stage public companies. We think that'll be good for America, good for startup ecosystem. So yeah, if you want to, maybe it's your first angel investment or kind of browse through investments on WeFunder, check that out. But yeah, thanks so much for having me on, Nate. This has been a really fun conversation. And yeah, I love the idea of community rounds as a kind of tool in the go-to-market arsenal.
I've got one more bonus, last minute lightning round question. Did you guys trademark community rounds?
I don't think so. We don't really do trademarks. We'll out compete by execution and speed versus trademarks. Now Nate's going to go and trademark it. I don't know. We may have done, not to my knowledge.
I don't think I can trademark it. I think I have to maybe I'll go throw up a landing page and then trademark.
Now you're making me want to go and trademark it. The way you're talking is making me immediately want to go and trademark it. We may have done. I don't know.
Mines will spend the $600 and get the trademark. You could at least print it out and put it on the wall.
You're sounding like one of those angel investors in Iowa, man.
Don't say that, Jonny.
300K post. Here we come.
But Jonny, this has been a lot of fun, and we'll put a link to your LinkedIn in the show notes, as well as a couple links to the WeFunder site, the Raise landing page, the page for investors to take a look at some startups. So check out the show notes if you want those links. And Jonny, would love to have you back. Thanks so much. Take care.
Love it, man. Cheers, Nate.
And that's a wrap. And I just want to thank our sponsor, Positional. They've got what is a pretty awesome tool set for content marketers and SEOs. They've even got a couple tools for social media. We'd love for you to check out Positional and the tool set that we've created over the last 15 months at positional.com. And you can always reach out to me if you have any questions. My email is nate@positional.com. Whether you've got questions about our tool set or comments and complaints, or even positive feedback about this podcast, I'd love to hear from you. And don't forget to hit the like and subscribe button wherever you are listening to this podcast. Thanks so much for tuning in. Bye.